If you own property, if you're investing in property, or if you're just dreaming of finally stepping onto the property ladder, there's a chilling phrase doing the rounds right now, an economic doom loop. You've probably seen comments about it, headlines screaming about it, or videos warning you of impending disaster. But what exactly is an economic doom loop? And is UK property, the wider economy, genuinely caught in one? Today, we're unpacking it all clearly, calmly, with facts and data, not panic and speculation. I've spent over a decade building property businesses, British Homebuyers, a home buying company, and British Homesellers, an estate agency. And with over 14,000 transactions completed, I've studied market shifts up close. So let me break down exactly what an economic doom loop is, the signs you need to watch for, and whether the UK property market is genuinely on the edge, or if this is just another scary headline. So what exactly is an economic doom loop? An economic doom loop isn't just another catchy phrase. It describes a scenario where rising debt and interest costs spiral out of control, causing a vicious cycle of higher rates, lower affordability, falling asset prices, and further economic stress. It looks something like this. Governments issue more debt, bonds to fund spending. Rising debt levels spook investors who demand higher interest rates. Higher rates make debt even harder to service, worsening deficits. Mortgages and loans become more expensive. We've all felt that. Property prices and consumer spending start falling. Just look here how house prices, adjusted for inflation, have dropped 16%. And of course, governments respond by issuing even more debt. And so this cycle continues downwards, repeating and getting worse and worse. And a simple, obvious side effect that you can look out for is yours, your families, your friends, anyone you know. Are you seeing in general standards of living are increasing or decreasing? Share in the comments below. Because that is the price paid, the consequence of an economic doom loop. I've got an active poll on this channel you should vote on if you haven't already. Because right now, 94% of you that have voted are not happy with the current UK government. How mad is that? But is this economic doom loop happening in the UK right now? And what indicators can we actually see in the data? So are government debts spiraling out of control? To see if this doom loop scenario stacks up, let's first examine government debt. UK government debt currently sits at around 2.8 trillion, almost 100% of GDP, 96.4%. Interest costs have surged over COVID. In 2023-2024, the UK government paid around £107 billion in debt interest alone. The blue line shows the OBR's forecast and how it's expecting that to rise. That is 3.9% of GDP, but importantly, look how it has increased from the lows of 1.2% of GDP before COVID. Crucially, 25% of UK gilts, government bonds, issued during the pandemic at ultra-low rates, below 1%, are maturing soon, requiring refinancing at today's higher rates of around 4.5% to 5%. So what this means is the cost of servicing national debt is rising quickly, but the UK still technically isn't near a critical threshold like some doom loop theories suggest, such as debt interest exceeding 50% of tax revenues. We're at about 10% right now, rising but manageable for now. It just comes to show there is still a lot of rope for the situation to get worse and worse. So importantly, if you look back in time to compare, after World War I and then World War II, debt increased to over 250% of GDP to then come down over time after. You can see in this forecast from the OBR that if current policies are left unchanged, government debt would rise towards 300% by 2070, which is why we're seeing so much change in taxation, in cost cutting, because clearly that trajectory isn't sustainable. And it's very possibly why the Chancellor has been getting all upset. Look, like her or hate her, she has an impossible job at the moment. But let's talk about something else that could push us into a doom loop. The baby boomers and the property wall theory. One doom loop theory predicts a property crash because baby boomers who own roughly £2 trillion of UK property will soon pass away or downsize, causing a flood of properties onto the market all at once. For instance, the over 65s own 62% of UK property right now, but only 4.9% of the mortgages. But let's check the data carefully on this. The oldest baby boomers are now approaching their early 80s. Statistically, homeowners tend to move or downsize around 80 to 85. Over the next 15 years, about 2.5 million homes held by this generation could enter the market. So this might seem alarming, but it's around 170,000 additional homes per year spread across that 15 years. So it's unlikely to trigger a crash on its own. So what this means is, yes, increased supply of baby boomers would add downward pressure on prices, but it's gradual, not a sudden crash scenario. So let's explore the next doom loop narrative. Interest rates, the real flashpoint. Interest rates are the critical point in the doom loop narrative. Let's examine the facts closely. After a decade of historically low rates, near zero, UK rates have surged 4.5% over this year. Higher rates mean obviously mortgages become expensive. A £250,000 mortgage at 1.5% cost £1,000 per month. At 5%, that's £1,460 a month, a 46% increase. Many homeowners who locked into cheap mortgages in 2020, 2021 now face a shock. Roughly 2 million mortgages will refinance at these higher rates by the end of this year. So this genuinely threatens affordability, it reduces spending power, and potentially is triggering for sales. With my estate agency, British Homesellers, it's a common theme we're coming across all the time at the moment. People selling purely because they're remortgaging at higher interest rate, and it's just not affordable. So what does this mean? Interest rates are creating serious headwinds, but central banks can ease this pressure if inflation stabilises. It's not yet catastrophic, but it is concerning. But it isn't just the UK that matters in all of this. The global context and the US matters. Let's talk about the global context and the US debt problem. The US economy matters hugely here because global interest rates track closely with US bond rates. Let's clarify what's happening there in the US. US debt recently surpassed £35 trillion, over 120% of GDP. So that's far higher than ours at around 100%. US annual deficits are around 2 trillion. They are borrowing heavily to meet their spending. And that's what got Elon Musk all upset with the big, beautiful bill. US Treasury bonds have jumped from under 1% in 2021 to nearly 5% this year. Many large buyers like China are selling bonds, not buying, putting upward pressure on yields. If the US struggles to fund its debt, global rates rise, directly affecting UK mortgage affordability. So what this means is the US debt problem does add significant global risk, making it harder for us, the UK, to control our own interest rates. But let's talk about how gold ties into all this, the role of inflation and gold. As you guys always, or some of you, comment about gold in my videos, and rightly so, commodities and gold reserves are rising. So how does this play into all of this? Central banks, especially outside the West, have boosted gold reserves, diversify away from the US dollar. So that's why gold prices rose around 40% since 2023, signifying lower confidence in paper currencies and fiat money and higher inflation expectations. Persistent inflation makes rate cuts unlikely, further pressuring affordability. But there's a nuance to all of this. While inflation complicates rate cuts, slowing economic growth could eventually bring inflation down, stabilising rates. So what is a realistic property market outlook right now? Let's bring all of this together. Where does UK property realistically stand? Short term, over this year and next year, I think likely some downward price pressure due to affordability issues and higher rates. So what this means is possibly modest price corrections of 5 to 10% in some areas, maybe worse in some areas. Average house prices, however, are likely to keep slowly rising at rates behind inflation. Medium term, over the next 5 to 10 years, I think there'll be a gradual adjustment to higher rates, but no catastrophic collapse, as ultimately demographics and government policies cushion the impact. There will be a continued shift from private landlords to corporate ones, the corporate rental market. Long term, over 10 years, I mean, who knows? I think we will see slower, more sustainable growth once new norms of interest rates and affordability get more and more established. But sadly, most of us will all likely just adjust. But let's be clear, is the economic doom loop actually happening? Let's clearly answer this question. Debt levels are rising fast, interest rates are causing pain, and affordability is strained. But an economic doom loop, an uncontrolled collapse, is highly unlikely because governments and central banks have powerful tools, rate management, bond purchases, fiscal policy. Instead, expect continued short-term pressures, potentially lower prices in real terms, but no complete market collapse. The UK property market is adjusting, not imploding. Often forecasts don't account for adjustments, and because the world runs on fiat money, governments, central banks can fiddle with the game, keep running the game longer and longer. Just look at what happened over COVID, how they fiddled with things. But this will likely be the side effect of all of this. I hope this video gave you clarity, not panic. I'm sorry if it's created any panic, it's not the intention. If you found this valuable, please hit and subscribe, share this video, it helps us grow, and let's keep making sense of this market together. I'll see you in the next video up here.